Remember, Bitcoin's only been around for now 13 years. It's a baby of an asset, and we just don't have enough data to really know for sure how it's going to behave. Yeah, so I think the key here is to just understand what type of market we're in. When you're in a bear market, it takes a lot to get price to go up because people are scared, right? So, if you're in a bull market, you could have the tiniest bit of news and price will rip up. It could even be news that's not relevant. And we've seen stocks like GameStop, AMC. I mean, all these things just go to the moon. But the problem is we're in a bear market, and in a bear market, people really need value. They need to know that something is immediately changing, and the merge isn't doing that, right? Yes, long term, it's probably fantastic for Ethereum, but in the near term, what is everyone focusing on? The Federal Reserve, interest rates, the US dollar, the economy, and all of those things are just crushing risk assets right now. So it was kind of a no-brainer to me that you saw a kind of an early front-loaded run up a few months ago, and then it just kind of came right back in. The narrative that has changed is the Fed has continued to be so hawkish. I mean, much more hawkish than even I thought they would be. I've kind of been in the conservative groove where I'm saying to myself, all right, the Fed needs to be careful here, because if they do tip us into a bad recession and inflation is still above the 2% mandate or 2% sub-mandate, then how do they get us out? The markets are going to look towards the Fed and say, hey, could you mind printing some money and get us out of this like you have for the past 20 years? And the Fed's going to be like, can't do it. We don't have 2% or under inflation. We can't print the way out. And I think that's starting to kind of have an impact here, where the Fed is just so hawkish and just kind of gangbusters ahead. It almost reminds me of an emotional reaction. They know they messed up printing too much prior. Now they're trying to make it up with another wrong, and two wrongs in this case do not make a right. So the markets are headed down. I think we're oversold near term, so it wouldn't shock me to see a bounce next week. But at the same time, I still think the COVID highs just before March of 2020, that has the target written all over it by year end. And again, that's at around 3,385, so 3,385 on the S&P 500. What it was when they came out, they raised expectations for the next few hikes, and that's what shocked the market. So the dollar took off. Look at the 10-year yield. I mean, the 10-year yield is above 3.7% now. The 2-year is well above 4. I think it kissed 4.2%. That's an incredible inversion and a very scary thing. And one thing that I think, and again, it blows my mind the Fed's not kind of talking about this, or maybe not aware, but when you go back to Volcker back in the 80s, he kind of had this stutter step where he raised from 12% to I think about 18%. That's about a 50% hike in interest rates at the time. Now think about the difference in interest rate hike percentage wise from where we were until where we are now. We were basically at 0, and now the Fed has us what, at 3.25? I mean, percentage wise, this is an enormous hike, way more than Volcker back then. And it's going to have a major impact on the economy. And again, this is what scares me about things is like, it's one thing to say, if we go into recession, the Fed can save the day by coming in and, doing what they've done. But if you have inflation that's sticky around 4 to 5%, which is what I think it's going to be, how do you get us out of it? And are we going to be in a protracted, a long-term bear market? I think the bond market, which is a smart market, it's known as the biggest market, it's the smartest market. They see that you want to let the economy digest these rate hikes. And I think that's the major issue here, is that the Fed is doing them one after the other, 75, 75, 75. And you're not giving time for it to cycle into the economy. So for all we know, in 3 months to 6 months, when all of these hit the economy, we could find ourselves in a nasty recession. And again, that's what I think the market's getting skittish about. You can see the dollar is skyrocketing again today. That's putting pressure on risk assets across the board. And again, there's this kind of, it makes me think that the Fed is trying to reestablish credibility, but it's almost like they're doing it in the wrong way, right? They're not doing this measured, methodical approach. They're just saying, you know what, we got to punish the market because you guys expected us to be lenient forever. Now we're going to really kick your butt and show you that we're not. And I think that's really dangerous. I think the key is this, and this isn't being talked about very much in the media, but it's really worth noting, is that the last 2 nights, Japan has intervened in their currency markets to prop up the yen. And what they're doing to prop it up is selling US bonds, right? They're dumping bonds on the open market. But when you sell bonds, what happens to interest rates? It pushes interest rates up even more. So not only do you have a Fed that's saying, hey, we're going to keep raising rates even after this last 75 basis point hike, we're upping our guidance by year end over 4%. But now you have other countries saying, hey, listen, our currencies are getting crushed. It's hurting us. We need to now prop these up. We're going to intervene and then actually add to kind of the pain that we're seeing on the interest rate front. So it is a wacky situation. And it reminds me of almost going back to 2008 where things started to break, right? Where we started to have the derivatives market and all of these different things start to break down. And again, if the Fed is watching, be really careful here. And almost every single day, and I pay attention to the stock market and the news. Yeah. There's a new company that says, hey, we're going to lay off 10% of our workforce. We're going to cut X amount of spending, and all of those will loosen up the labor market a little bit. But I think the key is that it doesn't negate the shock that we already saw, where people at McDonald's or people at these different places are now getting, double what they were getting, $25 an hour or so in salary. Now you're not going to see those salaries go back down. They may not continue up, but they're not going to go back down. And so you have these businesses that have to figure out a way over the next few years to kind of come back in line with the margins that they had before. And that's where you get this kind of stickier inflation that doesn't get down to this 2% or sub 2% mandate. And I think even the Fed in the statement, they said they don't expect inflation to come down to 2% until 2025. Even if we went to a zero inflation number like tomorrow, a price of an apple is still up 50% from where it is. And so you can't just see wages all of a sudden go back to where they were. So I do think where we are in wages is what people get used to. People do not take well to wage cuts. And so I think you're going to see wages stick at these levels for the longer term. Now, they're not going to rise really, but at the same time, they're going to stick here. And again, that's going to be something that these businesses will have to pass through over time. And I think it's going to be a very scary situation when again, we do see the Fed continue to raise and push us into a recession, and then they're not able to get us out. And you could just look at stocks or markets like the Chinese stock market, which went from 2003 to 2008. It had this monstrous run, much like we saw over the past 5 years or so. And then since then, it's been in 10 years, actually 14 years of sideways chop. If you look at the Brazilian stock market, same thing, had a huge run in the early to mid 2000s. And then since then, those markets have just been up, down, not making new highs. And I think that's something that US investors are going to have to get used to. Now, as a swing trader, it's a good market. You get the swings intra move. As an investor, it's going to be a tough market. The Fed really pulled forward a lot of the upside, right? So we know that it takes time for lower energy costs to be passed through. So it's going to take a little time for that to filter through. And I also think the supply chain is slowly going to loosen up, right? It just takes time. It was a shock. The Russia invasion was a shock. A lot of these other things were shocks. But over time, businesses will expand their output of various things to compensate because prices have gone up. And if price goes up enough, it makes a business want to expand and make money off of those products that they sell. So I think those will alleviate and bring us down to 5%. I think as early as next year will be 5 or sub 5. But it's going to then be the last leg of the marathon is going to be the toughest. Think about 2021 when money was free and the government was sending out checks to Americans nonstop. And so there was just so much liquidity and money in the system that a ton of it wound up in the stock market, buying tech stocks, these tech stocks that had no earnings, that were trading at crazy multiples to revenue numbers. And now you're seeing this kind of suction. It's almost like a vacuum sucking the liquidity and the money out of the system through higher interest rates, through quantitative tightening, QT, and that's going to just bring down these asset prices. And we've seen, amazingly, like a stock like Roku down from $500 to $60, incredible type drops in these assets, but it makes a lot of sense since the money is getting sucked out. There's not as much money to go around to so many stocks now. First target is going to be back. So we are at a little bit of support per the chart. So you can see we bounced off these pivots right here. All right. And that's going to be a short-term little bounce. And then eventually we're heading back to basically just below 1,000, the double bottom. And then if I'm right that Bitcoin is headed to 12 to 13,000 and maybe even below, then I got to think that Ethereum could easily be headed down to, 700, 600 area. Yeah. So I think probably the 900 to 1,000 is the 3,700, and then the next leg lower in the S&P takes you down to that 600 to 700 level on Ethereum. So you can see you're basically just hugging a little bit of support right here. If the dollar continues to strengthen and the Fed seems to want to make sure that it does, then you're going to break this 18 to 19,000 level, and your next stop is not really until that 12 to 13,000 level. That's my best case. That would be if everything works out and everything is fixed and so forth. Worst case, you have to look back to the .com era when Amazon dropped 95% during that collapse. And if that's what crypto's going through, you could be looking at a $3,500 worst case scenario target on Bitcoin. But to be fair, I know enough from my career to know that I don't pick exact lows. Yeah. And so basically in the teens, I'll be already starting to accumulate all the way down below. So basically, you see 16,000, I'll pick up a tiny bit, 13, I'll pick up a little bit more, 10, all the way down there. And the idea there is I do believe that eventually Bitcoin's 100,000, 500,000. And so I'm not going to try to pick a bottom and miss it. Instead, I'll just dollar cost average in this lower range to build that core position. And that's the thing that investors need to understand is that every time you get a new candle on the daily chart, it's a new piece of a puzzle. And a good technician is going to go and look and say, okay, does this change my thesis? Does this change anything? And really what we've seen is the Fed's gotten more hawkish. The economic outlook for me is even more bearish based on the Fed being more hawkish, and that you have to start lowering asset prices even more. Remember, Bitcoin's only been around for now 13 years. It's a baby of an asset, and we just don't have enough data to really know for sure how it's going to behave.